Let's talk about one of the easiest, most common places to lose marks in your accounting paper. Seriously, it's a classic trap that ICAI loves to set, and it catches so many students out every single time. It all starts with a simple-sounding question.
So picture this. A company drops a huge amount of money, let's say 5 crores, on a massive advertising campaign. They're building their brand, right? They're creating future value for the business. Your gut instinct tells you, yeah, that feels like an asset. You should be able to capitalize it.
But according to Accounting Standard 26, the answer is a hard no. Absolutely not. It's an expense, and it goes straight to the profit and loss account. Getting this wrong is a guaranteed loss of marks, and honestly, it's a mistake we are going to fix right now for good.
Okay, let's dive deep into this. We're going to break down AS26, piece by piece, so you really get the logic behind these rules. That way, you'll be able to spot these exam traps from a mile away.
So here's our game plan. We'll start with what I call the recognition trap and get a super clear definition of what an intangible asset even is. Then we'll cover how to get it on the books with initial recognition. After that, we hit the really tricky part, internally generated assets. This is where the marks are. Then we'll look at the asset's life through amortization. And finally, wrap it all up with retirements and disclosures.
All right, first things first. Before we can even dream of capitalizing something, we have to be sure it even qualifies as an intangible asset in the first place. This is ground zero.
Okay, here's the official textbook definition. It's an identifiable, non-monetary asset without physical substance, you know the drill. But the definition itself isn't where the action is. The real key is understanding the 3 pillars that hold this whole definition up. Let's break those down.
Pillar number 1 is identifiability. Now this is crucial. This is what separates a specific intangible asset like a patent from just general fuzzy goodwill. And the test is simple. Can you separate it from the rest of the business? Can you sell it, rent it, or exchange it on its own? Or does it come from a specific legal right, like a contract? If the answer is yes, then check, it's identifiable.
Now, on to Pillar 2, control. And listen up, because this is a major area where marks are lost. It's not enough to get benefits from something. You have to have the power to control those benefits. And, just as important, you have to be able to stop other people from getting them. A legal right like a copyright, that's the clearest example of control you can have.
And this example just nails the point perfectly. Let's say a company spends a fortune training its employees. The staff are now way more skilled, and the company is definitely getting economic benefits from that. But can you capitalize that training cost? No way. Why? Lack of control. Those employees can resign tomorrow and take all those skills with them to a competitor. No control, no asset. It's just an expense.
And the third and final pillar is future economic benefits. This one is pretty straightforward. For anything to be an asset, you have to expect that it's probably going to help you make money down the road, whether that's through more revenue or by saving you costs. Simple as that.
Okay, so let's say we have an item that's passed our 3-pillar test. It's identifiable, we control it, and it's going to bring in cash. Awesome! So how do we actually get it onto our balance sheet?
AS26 is really strict here. It gives us 2 conditions that you absolutely must meet. You can only recognize an intangible asset if it's probable that those future benefits are going to flow to you, and this is a big one, you can measure its cost reliably. If you can't put a solid, reliable number on it, you can't capitalize it. End of story.
So these intangibles can find their way into a business in a few different ways. You might buy them outright, you could get them as part of a merger, sometimes you'll get them from a government grant, or you could even swap another asset for one. The accounting changes a little for each, but the core ideas we're talking about stay the same.
And now we get to what is without a doubt the biggest exam trap in this entire standard: internally generated assets. This is where ICAI loves to separate the students who really know their stuff from those who don't. First, let's get one thing crystal clear. Internally generated goodwill. You know, your company's amazing reputation, your loyal customer base, the brand you've built over years, it can never, and I mean never, be recognized as an asset. Why not? Because you can't identify it separately, and you can't measure its cost reliably. So just don't even go there.
Now this right here is a crucial distinction that ICAI loves to build questions around, the split between the research phase and the development phase. Think of research as the what-if stage, where you're just exploring and looking for new knowledge. Any money you spend here is always an expense, no exceptions. Development is what comes next. It's when you take those research findings and start building an actual plan or a prototype. Here, you might be able to capitalize the costs, but only if you meet some very, very strict conditions.
So, to capitalize your development cost, you have to meet all 6 of these conditions. You've got to prove it's technically feasible, that you intend to finish it, and that you'll be able to use or sell it. You also have to show how it'll generate future benefits, prove you have the money and people to finish it, and of course, reliably measure what you've spent. You need to memorize this list. A 5-mark question asking you to apply these 6 criteria is a real possibility.
And one last really important warning on this. Even if you think you're in the development phase, AS26 specifically says you can never capitalize money spent on internally generated brands, mastheads, publishing titles, or customer lists. The standard basically says you can't distinguish these costs from the cost of just running your business, so they are always expensed.
All right, we've done the hard part. We've successfully recognized our intangible asset. It's sitting there on the balance sheet. So what happens now? Well, now we have to talk about amortization, which is really just the fancy word for depreciation when we're talking about intangibles.
So here's a quick question for you. When you have something like a patent or a copyright, over how many years should you spread its cost? Do you think there's a maximum limit?
The answer is 10 years. But wait, this isn't a strict rule. It's what AS26 calls a rebuttable presumption. Basically, the standard assumes the useful life won't be more than 10 years. But if you have really strong, persuasive evidence that it'll last longer, like, say, a 30-year contract to operate a toll road, then you can rebut that presumption and amortize it over that longer period. Next up is residual value. Now, this is a very simple but very important rule you need to remember. For an intangible asset, your default assumption for its residual value, what it's worth at the end of its life, should always be 0.
Unless one of 2 very specific things is true. You can only give it a non-zero residual value if 1. Some third party has made a firm promise to buy it from you at the end of its life, or 2. There's an active market for that kind of asset, and it's probable that market will still be around when you're done using it. These situations are pretty rare, so your go-to should always be to assume 0.
So let's bring it all the way back to the beginning, that 5 crore brand campaign. Now that you've mastered the rules, why is it an expense? Well, for one, AS26 explicitly says advertising and promotional costs are expensed when you incur them. But on a deeper level, it fails our basic asset tests. Can you truly control a brand image that exists in customers' minds? Can you separate it from the business and sell just the brand? And can you reliably measure the specific future economic benefits that came from that one single campaign? The answer to all of those is no. And that, right there, is how you apply AS26 to nail these questions and secure every single mark in your exam.